Alright, listen up, you 20-somethings. If you are still stressing over picking individual stocks or maybe trying to buy some small cryptocurrency, hoping that it goes up 100x, or maybe you are even day trading stocks, I gotta tell you, you are making things way too complicated. What if I told you you could just buy one investment, super consistently keep buying it, and it will make you extremely rich? Most people overcomplicate investing in their 20s. And the truth is, you do not need 30, 40, 50 different stocks. You do not even have to be a financial genius. You just need one thing to invest very well, and that is the SP 500, specifically VU. That is what I like to invest in. So in this video, I will be explaining to you why this is the only investment that I believe that you need for long-term success, if you want to build real wealth. And before we jump into the video, do you think it is smarter to own an ETF that holds 500 companies? Or would you rather try to pick individual stocks? Go ahead and drop your comments down below. I would love to hear. So starting out with what is VU or the SP 500. VU is just Vanguard's ETF that tracks the SP 500. The SP 500 itself is just the 500 largest companies in the US. So these are companies like Microsoft, Apple, Amazon, JP Morgan. The thing that is nice about buying VU is that it is instant diversification. So once you buy one share of it, you are owning pieces of 500 companies. And the other thing that is really nice about it is that it has a very cheap expense ratio. It is only 0.03%, so it does not cost you, it costs you very, very little money just to own this ETF. It is not like you are paying a financial advisor 1% or 0.5% a year to try and go and beat the market, because you are owning the market. That is the nice thing about it. And the reality is most financial advisors, as well as just mutual funds that are actively managed, do not end up beating the SP 500 over the long term. It is so hard to beat it long term, so why not just join it? And Warren Buffett, arguably the greatest investor of all time, has even told most people that they should just buy the SP 500, and they will be good. And although he may invest into individual stocks, and he has built his wealth up on a lot of really big winners, I mean, he is telling you this is what he thinks works, and a lot of people should follow it. So I definitely think taking his advice is not a dumb idea. Now, the next thing I want to talk about is that the average return in the SP 500 can vary year by year, but on average, it returns about 10% a year, which is really nice. Some years it may return 20+%. Like for example, if you go look at 2023 and 2000, the market had a really nice rebound from 2022. I mean, we are talking 20+% in back-to-back years. But it also will have years where it goes down. You know, for example, we had huge crashes in like 2000 to 2002. There was something called the dot bubble. That was a pretty large crash. The next one is the 2008 crash. This is the housing crisis that happened. And then we also had the COVID crash that happened in 2020. And then the more recent crash we had was in 2022, where the market dropped pretty much because of inflation. That was like the main thing it seemed like, as well as interest rates getting hiked. But one thing that is really nice about the SP 500 is that if you consistently invest into it over time, like let us say you are starting out with $0 right now, and let us pretend that you are 20 years old. So you are going to invest for 40 years until you are 60. Now, if you put $500 in every month, we are going to assume that your average return every year is 8%, because like I said before, it is 10%. But then we want to factor in for inflation, so we are going to take 2% off of that. So if you are getting 8% a year, $500 a month in 40 years, you are going to have $1.5 million. And the craziest thing about all of this is that your portfolio would be worth $1.5 million, but in total, you have only invested $240,000. Which is the power of compound interest, because you have time on your side. And let us pretend that you are 20 years old, like I was just saying, but let us pretend you invest for 45 years. So you wait until you are 65, then that number goes up to $2.3 million. So yes, those extra 5 years added $800,000 in your investment account, and that is just looking at $500 a month. Let us say you start to ramp that up over time, and you turn it into $1,000 a month. And let us say we are back in that 40-year scenario. Then your total at the end will be $3.1 million, even though you only contributed $480,000. And if we go to the 45-year scenario, that number goes up even more to $4.6 million. So that is the power of getting even 8% a year. Again, we are doing the 10%. We are minusing inflation there. So 8% a year though, 500 a month or even 1,000 a month, over 30, 40 plus years is going to make you very, very rich. I think one thing people really struggle with is they want to get rich quickly, especially in their 20s. Like they feel this pressure that, hey, by 25, I have to, have a house. And I have to have X amount invested, and I have to be making a certain amount every year. But with the SP 500, you are going to be getting rich slowly. It is not going to happen overnight. But the more consistent you are, the more money you invest, the larger your portfolio is going to get. And like I said, it is not going to go up 100x. It is not going to have some crazy return, but it is still going to go up a very substantial amount, especially if you are doing it consistently over decades. And honestly, the way I would think about it is, let us say you get to a point where you have $100,000 invested in the market. Right, if you get a 20% return that year, which I know on average it is 10%, but let us say they have one really good year, right? Let us say it is 20%. You now just have $20,000 extra in your account. And you did not do anything. That is assuming you did not contribute any money. It just went up by 20%. You know, January 1st, you are at 100K. You do not put any money in. By December of that year, you are at 120,000. And if you want to make this example even more exciting, let us add another zero instead of 100,000. Let us pretend you get to 1,000,000 one day. Then 20% is $200,000. That is in your investment account, just in 1 year alone. And so although $1,000,000 is very far away, and 100K may also seem very far away, the more you invest earlier on, it is going to be easier and easier to move up. So going from 0 to 10,000, let us say that takes you 6 months. Then going from 10,000 to 20,000 will probably take you less time, assuming the market is going up at its normal rate. And then 20 to 30 is quicker, 30 to 40 is quicker, and it gets quicker and quicker over time. So that is one thing you want to think about, is although it may seem far away, you may only have to invest $50, $60, $70,000. But then your portfolio will get you to 100. And the thing is, with the SP 500, returning 10% a year, this is definitely beating inflation over a long period of time. Like I said, inflation is about 2% a year. So it is a lot better than just holding on to cash. Because if you just have cash in a checking account or a savings account and you are not getting any interest on it, then your money is actually going down in value every year. Your $1 that you are spending today is going to be worth less than $1 next year, because the price of everything goes up over time. Another thing I want to talk about is, why do I believe that the SP 500 is perfect for you in your 20s? The main reason, I already talked about this a little bit, is that you have time. Compound interest does all the heavy lifting for you, whether you are starting at 20 or 25 or even, 29 or 30, whatever that age is. If you start in your 20s, you have so much time to invest. And time is your best friend when it comes to compound interest. Do not get me wrong. The interest rate absolutely matters as well. But at the end of the day, the longer the time horizon, the better. And we even saw that just now when we looked at a 40-year time horizon versus 45 years. I mean, it was a massive difference on both scenarios. The next reason I think it is perfect for people in their 20s is because it is extremely low effort. It is not hard at all. If the market has a good year, it has a good year. Just keep buying it very consistently. And if it has a bad year, that is okay. 2, the logic and the mindset I try to put myself into is that if I put money in, let us say I invest $1,000 and it goes up, great, no, my $1,000 is worth more. But if I invest $1,000 and it goes down because the SP 500 has dropped, that gives me an opportunity to buy an asset that has gone up historically over time. I get to now buy it on a discount. The same way if you have a pair of shoes, or there is something out there that you want to buy, if it drops by 20 or 30%, the odds of you buying it are a lot higher. You know what I mean? So you got to kind of view it that way. It is just a win-win scenario. Either you put money in and your investment goes up and you make money, which is awesome. Or you put money in, the investment goes down temporarily, which is fine, and you just buy the dip, and you invest, and you are buying a really high-quality asset on a discount. So using that logic will help you long-term, especially when we get into crashes, where the market may be dropping for 6 months straight, 8 months straight, over a year straight. But at the end of the day, that is a really good buying opportunity. The next thing I love about it is that it is low cost. Like I said with VU, the expense ratio is extremely low. It is not like you are paying a manager 1% a year to manage your money just for them to underperform the market. And I will even make an entire video talking about why I do not believe people need a financial advisor, because some of that stuff will really eat away at your returns long term. The difference between getting 8% a year and 7% a year over a 30-40 year period actually equals to hundreds of thousands of dollars, believe it or not. So the low cost is very nice there. The next thing I wanted to talk about is that it is a lot less stress. And the reason I believe it is a lot less stress is because when you invest into individual stocks, if you put all your money into 5 stocks, then you are basically counting, these 5 companies need to do very well. They have to have really good earnings. Nothing about the business needs to start decreasing. You need to make sure the revenue, the profit, the free cash flow are consistently growing. You are going to be looking at earnings calls. You are going to be looking at the operations of the business, and you are basically just counting on all of your investments when you own individual stocks to continue to do well over a long period of time. For example, there are a lot of companies that were great in the 90s, but then in the 2000s, they completely tanked. They were nowhere to be seen, tons of companies went bankrupt. And so, a company can do very well for 10, 15, 20 plus years, and then just have a horrible 5 to 10 year period. Some examples of this are like 3M, or like Walgreens, for example. Like I remember growing up, I still see Walgreens everywhere. But Walgreens over the past decade has been a horrible stock to own. But if you would have told somebody that in like 2004, 2005, they probably would have laughed at you some thing with a TNT. That is a perfect example, where a TNT was such a great company. I think even in the late 90s they did really well, but since then they have done horrible, like it is not a good company to hold. And so when you own the SP 500, you do not have to sit there and stress about individual stocks. Like I said, it is the 500 largest companies. Let us say a company like Apple goes from being one of the largest companies in the world. Let us say instead of it being in the top 500, it drops to rank 510 or 515. Then it is going to get removed from the SP 500. So the SP 500 has a way of basically filtering companies in and out, basically if they fit that criteria or not, and also as the company were to shrink or grow. That changes its allocation in the SP 500. So for example, right now Nvidia has done very well the past 5 years. So it has become a larger percentage of the SP 500. And the reason that is nice is because as companies do very well, they are going to be getting bigger, and as they get bigger, they become a larger allocation of that total, which is always nice to see. And at the end of the day, when it comes to investing in your 20s, it is about investing consistently. You do not have to be the smartest person in the world. You just have to be the most consistent and work hard, and you are going to see a lot of really good results there. The next thing I want to talk about is how do you actually invest in the SP 500? So what you can do is you can open a brokerage account. This is just like a general investing account where you can deposit money in, you can buy stocks or ETFs, you can sell the stocks or ETFs, and take the cash out. You can move the money however you want. Also, when you invest, if you do decide to sell, let us say you have made $1,000 profit, you will have to pay taxes on that because it is a brokerage account, so just be aware of that. But basically just open a brokerage account. I use M1 Finance, you could use Vanguard, you could use Fidelity. You can search the ticker VO and start buying shares of it. And the thing that is nice too is some of them you can have an automated section where you can basically set it up. So it buys a certain amount every week or month. So you could set it up to where you are buying $500 a month and you do not even think about it. It just pulls the $500 out of your account. It puts it in your investing account and then it automatically buys VU for you. And then all you have to do from there on out is just hold long term. Just keep buying and keep holding. Whether the market does well or it does bad, just keep buying. That is literally that simple. Like people do not realize it. They think there is so much strategy to this. It really does not have to be that complex. Another option you can do is buy it in tax-advantaged accounts, whether that is a Roth IRA or 401k.